Hello and welcome back. Now, with our portfolio from last week being down already 2.5%, I think it's time that we address some of the current issues that have been going on throughout the last few weeks. With the Omicron variant, with fears of stagflation, inflation, and loose federal policy, things are not looking so great for the investors right now. Now, me personally, I am down pretty significantly right now. My portfolio was about 25% up in November. Now we are looking at something like 18%, so I've lost quite a bit of the gains. But nevertheless, that does not concern me because I have a very long-term outlook, which I believe that you should have as well. Now, here on this channel, we would consider ourselves more long-term investors. So a time horizon of 10 plus years is more relevant to us. And while mid to short term events which have been going on right now do affect us psychologically, we need to be thinking about our long-term plan. And from previous videos that I've made, I hope that you've already established at least roughly your long-term plan and that this short-term turmoil does not make you panic. Of course, nobody feels good about losing money, but this is just temporary. This is just part of the game. If you've accepted that you want to play this game of investing in the markets, then this is stuff that you will have to deal with on the regular. Now, this is not to say that it is impossible that things could get worse, because they could, and most likely because there is a certain law that says markets follow the path of most pain. It is highly likely that things will get worse. But that should not make you stray from your path, stray from your plan. You should hold fast, you should hold steady. Look at the data, which says that investing in indexes and investing long terms is the absolute best thing that you can do. And just continue to dollar cost average. Now, I probably have to explain what dollar cost averaging means. And I will. Now, dollar cost averaging is one of the most effective strategies for investing. What dollar cost averaging is that you basically take an equal amount of money and you invest it at equal periods of time. For example, if you have $1,000 and you invest an equal portion of that every month, so 1,000 divided by 12 months, or you could do the same thing but weekly. Say you want to invest $100 every week. You pick your asset, in this case as an example we'll use the S&P, and you invest $100 in the S&P every week. Now, whether it's $100, whether it's $200, whether it's $500, whether it's every month, whether it's every quarter, that depends entirely up to you and up to your strategy and up to the assets that you choose to dollar cost average in. But I want to show you an article by the Schwab Center for Financial Research to illustrate just how effective this strategy is and how simple it is to follow. Now, let's do that. Okay, so what this article does is it basically takes a look at 5 different hypothetical investing styles and compares their performance over a 20-year period. What the research did is that each of the participants had, participants, they're hypothetical, they're not real people, but each of them had $2,000 at the beginning of every year. And for the next 20 years, they've invested in the S&P 500 with basically the period was from 2000 to 2020. And obviously that period encompasses the dot-com boom as well as the financial crash of 2008. So it will illustrate how well that portfolio handled despite those difficult periods in the market. So each of them invested in the S&P 500 over a course of 20 years and they had $2,000 to do it. But each of them used those $2,000 differently. The first one is Perfect Peter, who is a perfect market timer. Basically, he's bought at the perfect moment in exactly every market at the cheapest price available for each year. Now, that is a strategy that you're either incredibly lucky or incredibly good. It is nearly impossible for normal people to attain that. I would say it's nearly impossible for anyone to do that, in fact. Then there is Ashley Action, as they call her. She took a consistent approach where she invested the $2,000 immediately at the start of each year. So as soon as she had them, she invested them. Then there's Matthew Monthly, who is our dollar cost averaging approach. which I think is the most realistic and most simple for most people to follow. He divided that $2,000 into 12 monthly installments and basically invested every month. Then there's Rosie Rotten, who she had incredibly poor timing and or perhaps incredibly bad luck, as the article says, and she invested her $2,000 in the worst possible day and in the worst possible month. And we'll see how her performance compares to the rest. And then there's Larry, who basically left his money in cash and did nothing because he never got to investing in stocks at all. And he was always convinced that there would be lower prices, but unluckily for him actually, as you will see, he did the worst. So the results, basically, perfect timing, obviously, as we thought, would do the best, but seeing as that is not realistic for most people, that is completely actually unrealistic for pretty much anyone. Investing immediately is a strategy that was the best, but by a very small margin compared to dollar cost averaging, which I think is the most realistic and the most simple approach that most of us can adopt. That is just to invest a regular amount each month. And despite that, Rosie Rotten, who had the worst possible timing, still did so much better than Larry, who invested nothing at all. In fact, you can see that she has almost 4 times as much money at the end of her 20 years than Larry, who did nothing. So you can see my example here. It's better off that you invest a little bit, even if it's at the worst possible time, and hold it for 20 years, rather than just keeping your money in cash. I think this example illustrates that perfectly. So what does this teach us? Basically, timing the market is nearly impossible and is completely unrealistic for pretty much anyone. So you're better off just buying at regular intervals or buying as soon as you get the money to do so and just holding. That's it. That's the best strategy that is research backed, that is data backed, and it's a strategy that works basically since the market has existed, which is 100+ years. There you have it. Simple. So the data is in. I will leave a link in the description if you want to check out the article by yourself. But I think it's fairly obvious that this strategy is a winner. And is short to midterm pain likely? Yes. Is a next market crash coming? Is a next market crisis coming? Yes, highly likely. When? Nobody can tell you. How bad is it going to be? Nobody can tell you. But historically judging, we can see that this strategy has performed quite well despite those tough and incredibly tough periods. So you're better off just buying, holding, and not doing anything rash or selling out during a bad time. So that's what I'm doing as well. Despite things going down lately and my earnings for this year are not as good as they were a month ago, I'm still buying in. I'm still dollar cost averaging. So I've increased the holdings in my crypto portfolio. I've increased the holdings in my stock portfolio. And I'll just stay the course and keep doing what I'm doing because this is the only data-backed strategy that is working long term. So that is my advice to you. If you start investing and you start seeing losses, those are not real losses. Those are not realized losses until you actually sell. But that number in red should not scare you because these things are normal. These things happen. Even a crisis, even a crash is normal. And I've experienced that through COVID as well, even though that one it was not as bad as previous historical crashes. I can tell you that it does not feel good. You have your moment of doubt. You have your moments of what if. You have your moment of I should probably get rid of something. If you follow your strategy, your plan, all will be okay. So we will continue to monitor our little portfolio over the course of next year and next few months, obviously. But that was my advice from this short video is don't fear. Just keep doing, keep at it, keep going towards your plan. Do not be afraid of a little economic downturn. It'll pass as it always has. And yeah, that's it. Now today's video has been a little bit shorter, But I really hope that it has given you a little bit of value. It has taught you a little bit. And if it has, I would really appreciate a like and a comment as well. Always welcome. And I thank you for watching, and I'll see you next time.